Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. I'll be your host. I've got Patrick Karim with us, NorthstarBadCharts.com. If you want to check them out. Thanks for coming on, Pat. You've been on a couple times before. Really appreciate you coming on.
Yeah, well, I love being on your show, Andy, because we're looking at big picture stuff. We're looking at whenever you got to zoom out. Like we just talking before, like today's price action. I don't know, CPI or some type of like macro uh, economic indicator came out today. Markets are dumping in the morning. Now they're green, and somebody who has a short-term framework or is trying to rationalize what the headline news are telling them, what that's supposed to mean, right? High inflation, markets are supposed to tank, hawkish Fed, not hawkish. And then a day like that, when it whipsaws, it destroys your emotional capital because all that time you were invested in trying to understand, oh, I think I got a grasp on the markets. The market guys, they don't deal in smaller timeframes like that. They deal in these big picture charts, these macro tidal waves that are shifting. They take months, years to play out. And if you're zoomed in, you won't understand anything. And I'll tell you one thing I've realized: the context, whatever, let's say, like a recent discussion was Fed pivots. People, I put out a poll asking people, what do you think is going to happen in the next Fed pivot? Is the market going to melt up, or are they going to crash? Well, it depends when the pivot happens. So if you don't have enough big time frame, usually when the SPX has broken down versus PPI, Fed pivots have actually made the markets crash, nosedive even more. Like in 2001, when they started cutting, the markets tumbled even more. In 2008, the same thing. But in the 80s, when the SPX had broken out versus PPI, then when they did those rate cuts, it was perfect because they were doing it probably for better reasons. There was enough liquidity. It was just, and they kept propping up the markets throughout the 80s all the way to 2000. So you cannot see this stuff if you don't take a bird's eye view. So I'll let the day traders do their thing. And right now I'm specializing in understanding the turns. So you just don't want to fight those tidal waves, Andy. You just don't. Your wealth could get destroyed, or it could be augmented just by understanding when it's time to buy the dips and when it's time to sell the rallies. Because all these people buying into US equities right now, they think, oh, it's going to the moon. Well, it's not. Like, that's not what's going to happen right now, as the charts are proposing the odds of happening.
Right. Yeah, so I was on your Twitter account looking at a lot of your big picture view charts, and I was looking at it going, man, this one looks good. Man, this one looks good. Man, this one looks good. And I presented a couple on the channel too because they were so good, and I wanted to get you on to get your opinions on it as well. So a couple of them were like PPI to SPX, the gold to SPX. You had a uranium chart. You had these big long-term kind of like breakout lines or big long-term breakout lines that we were just about to break, or we just starting to break above them. Can we look at maybe one or two of those? Have you walk through one of them just to take a big picture view? And the reason it's such a big deal is if you get the perspective right, I think, and you get the main big direction right, all these things. One, if you get the direction right, you can kind of stay long, you can remain long, even though you've got this short-term market noise and volatility. It also describes and paints a picture of the overall macro environment. So I think they're all kind of intertwined together. And if you get the macro right, that's just a huge tailwind behind you. So, yeah, that was one of them that I was looking at.
Yeah. So this chart, I don't know why I never charted. I used to do a 100-year chart for SPX. So this is SPX on the quarterly candles divided by PPI. And what's fun about PPI is because the Fed's been monitoring that forever. So you have a data series going back to 1914. So here's the bubble of the 1920s. So SPX back then, or the Dow, outperforming PPI. That's doing great. Your money has to be in US growth stocks. The 1929 peak, that's fine. Decades move on. Here you go long oil, gold, well, it was peg, silver. Then US equities start a new bull era versus inflation or PPI in late 1940s, and it goes up. This is the go-go 60s, Nifty 50, IBM, like all that stuff is going nice. We don't know this line, this upper line, guys, just forget it for now because we don't know it exists, right? It has to morph into existence. So the price action stays around here. And now the price action is reacting on a pivot line, which is starting to morph into existence. We see here, there's a reaction point here, another one here. It's a pivot line. So when it's under, it's a wall, it's resistance. But when it's above, it's also a wall, it's support, right? And in technical analysis, you have to give a lot of importance to price reactions on median lines, on pivot lines. It's not just support that's under that never gets breached. When it gets tested on either side and there's bounces, it's the market trying to figure out, okay, this is important, and they're attracted to it until they're not attracted to it anymore. And then it tries to find a new plateau. This is a big topping structure through the 60s. Even if they were climbing up, you see it's losing momentum. And then when it really falters, that's when we had the bull era in gold, silver, uranium, everything during the 70s. Hits this bottom rail. So here we have the first touch, second, third, fourth, fifth, a bounce. Even if it's 60 years later, guys, it doesn't matter. TA respects this. It bounces, cannot even go back above the median line, and then tumbles some more, and even below here. So when you're below that historical low, that's when people think, death of US equities, gold to whatever, 3,000, even if it was like 800 or whatever it was in the 1980s. But those are blow off tops in the opposite direction. So that's when you say, okay, this is exceptional. It's below that line. But then after that, it managed to climb back in. It's back in the above that pivot line. So now you got to declare this a false breakdown. And false breakdowns over a 60-year line or 70-year line, they're super meaningful. So now you got to say, okay, got to switch my guns. And even here, I could have drawn a descending trend line. So stuff was happening in favor of US equities back in 1980, 82. Then you're long US equities versus inflation. Look at that. Even years later, it's starting to react here. And a lot of people, this is puts things in perspective, because we all know 1980s all the way to the US equities are already above their 1960s high. But when I looked at this chart, I said, look at that. Adjusted for inflation, it's back in 1994 that US equities actually went in a melt up versus producer price index. So all this was just to catch up back to what it was back in 1970. So imagine 1970 all the way to 1990, 20 years just to break even. So I know people are going to say you could have reinvested your dividend stocks, whatever, but just on the merit of this chart, it took all that time just to break even. And the actual melt up for US equities, where it really started making some gains above those 1970 highs, it started in 1994. This was the blow off top. And what this happened, look where it stalled, right back at the 1929 peak. But we still don't know yet. And this, guys, just for you, it's a pitchfork. So pitchfork, you take an incline from an important bottom to a top. Then after that, you just draw it out. And then you try to have these are parallel lines, and you see the most reaction points. So we know here there's a lot of reaction points on this angled trend line rising. We know here in the median line. So even in 2000, if I would have drawn this chart having just known this was a pretty important, this kind of validates the whole pitchfork channel, because the reaction now, it respected the angle of SPX versus PPI right here in the 2000 bubble. And what happened? Huge move down. That line was super critical, came rushing back down, hit that median line once again, bounces up, cannot make a new high, and then tumbles again below that median line. You think it's going all the way down here, but it decided to climb back up, magnet, and after that climbs back up. And here we are today. This, for a valid trend line to morph into existence, it needs at least like 3 bounces. And I hadn't looked at this chart in a while, and look at that, we get a third confirmation. So we kind of missed it, maybe a couple of months ago, this thing was already reacting off this 100-year trend line. Like this is ultra powerful. If US equities were to outperform PPI, Andy, the case would have had to be here. It would have had to do it here and bust out and do some type of melt up top, like we had a melt down bottom right here back in the 1980s first in favor of inflation. It had a chance to do it. It was right here. It didn't do it. It failed to do it. And I'll bring you to these game over lines. So these are beautiful rising trend lines, breaks down. Beautiful. I could have drawn another one here in the mid 60s. Like I've drawn it on other charts, but now I drew lines from a bottom here to the top. Look at this one from the 1980s, clear breakdown. And it broke down again. So 1 touch, 2 touch, 3, 4. That rising trend line is uber valid. Peak, bounce off that peak, close below the trend line. I don't know what else to say, guys. It's like this will be marked in the annals of history. This is the equivalent of our 1929 or 2000 peak and 2021 peak. I don't see any other. And if we're calling it melt up, inflation adjusted right now, until the price action could get back above that game over line, there's no bullish bias to have right now for US equities. Inflation are going to keep outperforming US equities for the next 8 to 10 years. Sorry, that was long, but this chart,
I like it.
I'm happy we showcase it because it needs this. It needs attention.
So I just want to make sure everybody understands. So the producer price index is basically the costs for producers, right?
Yeah,
that's more or less the commodities cost for them.
Yeah,
as producers.
I could overlay the CPI. It looks pretty much the same. Sometimes you could do producer price index versus the CPI to see which one's leading the other one. But essentially, it's inflation costs. So this, it's always a fight between commodities and US equities in those big asset classes. It's either your growth stock and it's price to earnings and trying to always growth, versus there's no more growth. There's inflation, causes recessions, and down you go. And then they have to print more money, more monetary imbalances, more destruction of purchasing power. All this, as this is tumbling down, they had to do destruction of purchasing power to prop that up. Here in the 70s, huge destruction of purchasing power. And if you want to know when they're destroying your purchasing power at an accelerated pace, just look at the oil price, the silver price, the gold price, uranium price, anything that's real in fiat. If they're starting to add zeros to those commodities, it's not just the supply and demand dynamics. That's probably a minor part of the price. It's mostly because they're just depreciating your fiat currencies. And this is my target. Like it's an aggressive target, but it's going to come and retest the side.
Why did you put the target on the middle of the pitchfork? Is that where you think it's just going to slow down there?
Yeah, it's a magnet. So price, they're attracted. We look, this historically, this median line is it's a question of time to test that line. Will it test it in 1924 in the first quarter of next year? So that means that means some crazy bearish action, right, for US equities versus PPI. And also I did it's one of my techniques. I did a crosshair type technique. So I know that line's going to get hit eventually. It's destined to at least get a touch like a 2002 bottom. And I know this is a breakdown line from that top. Here's a reaction here. Here's a reaction here. Here's the breakout. So I'm triangulating, or I don't know what you call that, two coordinates, and it's giving me this point right here. This is a logical place where it should hit, but that's a huge drop from where we are there. This is, I've done other charts where US equities are going to lose 80% of their value measured in gold, measured in anything, measured in oil, measured in uranium, whatever. Divide US equities. That's what it means. So it's a drop from 21 all the way to 9. It's a huge drop in value. So even nominally, what could happen, Andy, is if I would have just put the SPX chart, we all know the SPX in the 2000, before it crashed in 2008, it was almost here back at all-time highs, right? SPX almost went back to its 2000 peak in 2007. But because it's adjusted for inflation, it's much lower its real value, right? So nominally, people think, oh, good, I broke even in 2007 before it crashed. But adjusted for inflation, it was not that good. I know in the 60s here, before this started tumbling, US equities actually did a nominal new high, higher than 1966 back in 19, or right here before this tumbled down. And then after that, it crashed down. So this is a huge clue, a weight of evidence that we cannot dismiss. So everything we do from now on, guys, you want to zoom in on the daily chart, on the weekly chart, you have to consider that this has happened. So this should make you, should I be buying the dip in NASDAQ stocks? Should I be buying Tesla? Or should I be looking at uranium? We could look at the uranium versus SPX chart, or you're looking at all these other instruments. This should dictate where the capital flows are going to help.
So this chart here is, I mean, you're charting the producer price index, which is more or less an inflationary type environment versus a disinflationary type
Yes.
environment. As the SPX outperforms the producer price index, that's a disinflationary environment. And as it goes downward, that is an inflationary environment.
Yeah. And you'll
for the most part, you know, for speaking kind of in general.
Yeah, it's mostly that. And this inflation causes recessions. I did another chart that all these periods when you're below the game over line, there's a multitude of recessions that happen. There's more recessions that happen in this area here because that inflation, for whatever reason, more inflation, they have the margins reduced, they have to lay off people. People can't buy more stuff. They have to buy like just the commodities, right? Food, stuff they need to live. All the money goes towards those commodities. Here, there's almost practically no recessions on the way up here. And if there are, they're small. They're you know, it's like maybe just 2 quarters of negative GDP and then off it goes. Mm-hmm. So we're going to expect more inflation or sustained inflation during all this period and recession. So I don't know if that's a definition of stagflation, but more recessions, more prolonged recessions accompanied with persistent inflation.
Yeah. So and why is it so important when you break that trend line going up? When you break below it, I mean, I know that we look at it from technical analysts like, yeah, we want to break the trend line, but why is that so important when it gets broken? The trend is broken, right? That trend of what we were in is now broken for what's coming up in this future. Is that, am I stating that right?
That's right. And okay, this is a log scale, guys. So log scale is it moves in magnitude, right? So here for an inch, it's is a percent. It's not it's not like here 17 to 21, it's 4, but here it's 0.7 to 0.9, right? So this move here is a lot more important. So this, if I would have put this on the linear scale, this would have looked like a blow off top. It wouldn't have felt like that. So a trend break, another way to see it is a slowdown in momentum. Each line that gets broken down, some people say, oh, but Patrick, there's a line here, line here. Yes, but look at the angle of the line. A steep line is strong momentum. If you're able to stay above and bounce, it's strong momentum going up. So it wants to keep going up. The capital flows are flooding it. It's going up, up, up. As soon as you break down the trend line, that means the momentum has slowed down. And now that becomes resistance. And if you can't do a new high, you're just going to topple over. Look in the 60s here. The momentum was slowing down. I could have drawn here a rising trend line all the way to 1966. And then, oh, that trend line's broken. So momentum slowing down. You see these highs, they're marginal on the log scale, less and less high until you're running up the hill. And then you're just exhausted and you just roll over. And that's every single time when you move up on the log scale and you start breaking these trends. And look at the angle here. It's starting to get it's not as steep as the 2000s, right? Because usually if you break a trend line that's pretty steep, you still have upwards momentum. You're able to, you know, catch your step and keep going up. I wasn't greedy on this one. This trend line, it's ready to topple over. The 1929, and when it topples. Look at that. It's like it just vomits, you know. It's like, whoa, engine crashes. Look at that here, the vomit in the early 70s. The 2000s vomit, and here the 2008 vomit. And we're in the first one right now, guys. Sorry about the graphic usage of the word vomit, but essentially that's what it is. It's like you ran out of breath, and now you're puking. The marathon's over, guys. You ran too hard, and you need time. Time is required for this to heal. The healing process, like Austrian economics guys, they always say this: you need bankruptcies, you need a cleansing of all the excesses done in everything, cryptos, NFTs, all that stuff. Too many big companies hiring too many people. They always thought there was growth. Now they have to cut. Well, it's like a self-fulfilling prophecy. So to think that this is going to go back up, it could stall for a few months, a few quarters, but eventually the destiny is that median line. Before even expecting some type of important bounce there, it's tough to see that. And after that, after this midway bounce, and then there'll be another drop, because you'll notice they come in twos. Here, the 1929, it crashed, it went back up, and then it plummeted, and then it tried again. It did a third time before it got up. 1970s crashed, tried to get back up, and then it tumbled here a little bit, like a little stretched version, analog version of the 1930s. And here in 2001, again, they come in twos. It's rare. It's going to be a V-neck recovery after SPX breaks down versus PPI. I haven't seen it yet. So here it goes down, tries to get back up, but then the second wave of whatever, it needs a second cleansing, and then it drops again. there's like, so that's telling me, using history, previous examples, the odds are of a V-shaped recovery for US equities versus PPI. It's never happened before after it's closed below this game over line.
So if one could sum it up and take something from this, we're very expensive for stocks in relationship to the producer price index because we're so high on that chart. We're right at the top of that channel. So it's expensive. We've bounced down below it, broken out of the trend line. We are now broken the trend. It's going into something new. And we could see the producer price index outperform the stocks, which means that we are in an inflationary environment for probably a good while. And now, what about like some of the assets compared to the SPX, like gold, uranium, whatever else that I saw? You had a lot of charts. So basically, you painted the picture that the stock market's going to underperform the producer price index, and that in these types of environments, the way that I view it, all these other commodities are going to outperform here. Yeah, so let's see if these ratios are about to outperform the SPX.
That's right. So confirmed breakdown for SPX versus PPI, but gold has not broken out versus SPX. So this is the gold versus SPX chart. I could have done SPX divided by gold, but right now, so if this breaks to the upside, that's favorable. It confirms what the PPI has shown us a couple of quarters ago. Here's the 1960s. The trend line goes a little bit further, but there's many touches, breaks out, retests, and then we all know this is the outperformance of gold versus SPX. So the ratio back here was 0.45 or something like that. And then after that, the end game ratio was 7.4. I think even on smart time frames. So that means gold in the 1980 was worth above 7 times the value of SPX. That's crazy. So let's say SPX was 200 or 150 times 7, and then you get the price of gold. And I'll come back to this because this is a great way. I thought about this a lot, and this is a great way to estimate targets that are outside of the actual price chart targets, like a classical TA guy would do it. But this is based on capital flows defining the framework of how stretched, because we could be in an inflation cycle. So that's why it's good to look at the ratios, because imagine we're in a hyperinflation cycles. SPX could go 10,000, but where is gold going to be? That's what's important, right? It could be 60,000, 70,000. So you got to look at ratios or it could be deflation, right? SPX could go down 500, but if gold is worth 7 times that 500, then you're doing great. Gold preserved your purchasing power on the way down. So let's say this goes, so this is another target. Here's our disinflation cycle, 1980s all the way to here. It broke out in 2001. Here was the move. So it went from, again, 0.45, about the same areas that we are today, guys. And this is important. This is it's a previous 2 times it was a launching pad. Here was the move. So I took these 2 lines, guys. I just did a click and drag of these 2 lines, and I just added, let's say we did break out. We're very close, like we're at 0.45, 0.46 today. Mm-hmm. I think at 0.50, it's pretty much, if we get a monthly close above that, we're going to be breaking out of this 1, 2, 3, 4-point breakout line, which is very important. And just this angle of ascent. So if we do a repeat of the 2000 cycle, I got a 1.6 to 1 ratio. Okay, bring your eyes down. This is important, guys, because we have to establish the constant. What will SPX be when gold peaks? And this is super curious. This is super interesting. SPX, most of the time, or practically every single time, it's at the same level it was when gold peaks. So when SPX started breaking down, so 10 years of inflation, it goes sideways. Every rally, this is a nominal SPX, guys, at the bottom. You see here, it's trying to get back up, but there's inflation. It can't work out the excesses in one shot. 10 years later, it's back at the same level it was nominally. And that's when gold actually peaks, because gold's going to peak when SPX finally breaks out of its huge base it did and starts outperforming. Now capital flows decide to go back in growth stocks, and gold, commodities, and friends, they take a move back. So all the monetary imbalances, all the purchasing power destruction that was required to keep nominally afloat the SPX during those 10 years. Well, that fueled gold. So like SPX was about 110 and 180. 110 times 7.4 was pretty much we all know it was, I think, 800 or 900, the peak in gold in 1980. Here in the 2000s, SPX was about 1345 when it started tumbling. 10 years later, was at 1345. 1345 times 1.6. That brings us pretty much to the gold peak. It was what, 1900 or something like that back in the 2000. So right now we know that the SPX is starting to tumble. It was around 4,000, or it could be a little less when this start breaking down versus the PPI. So let's imagine for these two previous cycles, we could estimate in 10 years, the SPX will be about 4,000 nominally. So right now we have that part of the equation. If I know that the ratio is going to be either 1.6 or 7.4, all I have to do is multiply that ratio times what I think the SPX value would be based on previous, and I get my gold targets. This is pure math. So logically, they will have to destroy your purchasing power to the extent of gold worthing or being valued at 6,400 at a minimum. If they destroy the purchasing power as much as they did in the 2000s in a disinflation cycle, gold will be at least 6,400 in 10 years, or 2032. If they need to destroy it the same way they did it back in the 70s, gold will be close to 30,000. Anywhere in between, then you could say, okay, fine, the ratio peaked here. US equities are starting to outperform. They're breaking out of their 10-year base, wherever the ratio lands. So this is based on previous history. Don't get impressed, guys, because I put a 0 or it's 3 times. This is nothing. Over 10 years, gold going to 6,400. Like, I keep mentioning this, but people don't even blink an eye if Amazon goes up 10x in 10 years. It's total nonsense. People are brainwashed totally. And people would say, oh, gold 6,400. What are you talking about, Patrick? Man, over 10 years, I don't know. I didn't do compound, but it's not that much, guys. And even 2,900, if they do something like in the 70s where they have to print to save, like the recession, when they really starts going, what do you think they're going to do? They're going to have to print more money, more bailouts, save people. Well, gold's going to start pricing that in, and it could get really bad. So
which camp do you think you're in for those two price numbers?
Jesus hell. Look,
I'll give my opinion after. so you're not the only one. I can tell you where I'm at.
Thanks for, I thought about this a lot of ways because there's so many fractals analogs. As a chart trader, I always try to see. I'll go with recency bias. So if I think that the system is financialized, but it's the closest history we had of a bull era for precious metals is 2001. So I could sometimes assume that, okay, the system is as close as 2000, the same type of logic. Okay, let's reproduce a 2000 cycle. It's the closest one, the last one we lived. Why not reproduce those type of, that type of cycle, right? A lot of people refer to the 70s, which is quite possible because then after that, when I look at charts, like the 10-year yield chart, which is breaking down out of a 40-year descending trend line, which it didn't do in the 2000 cycle. It remained within a descending trend line, the 10-year, the 30-year yield. Now we're breaking out of a 40-year descending trend line channel for the 30-year, the 10-year yield. And that looks like the 70s. So now I have a case where I have some evidence showing that I could be back I could have the 1970s type of cycle happening right now, more inflation than the 2000s. Jesus. And then add the debt on top of that. There's way more debt than both of those scenarios. But now we have the inflation of the 70s. Look, are you going to surprise me and tell me it's going to be more than 30,000? It's possible.
What am I going to say?
Oh man,
I can tell you my opinion on it.
Yes, please.
Here we go. This is my opinion is, and I'm not going to say the values there. I'm just going to give you my opinion on the market conditions. The 1970s was an energy crisis that was basically contained to America. We saw the interest rates break out just like you said in the 1970s. So the 1970s was an end of an era from the 40s to the 70s to 1980, I should say, of an increasing interest rate environment. We've got the 40s sprinkled in because we're at the beginning of a breakout, but we got the 70s sprinkled in because of the energy crisis. But the energy crisis is worldwide. If it's worldwide, I think it could blow that number out of the top It could blow that one out of the water. And the reason I say that, and I don't know if it's 29,000, I don't know the exact pricing. I just think the market conditions are worse today than they were back in the 70s. The 70s, they could expand and grab resources from the world. If the entire world's constrained, where are they going to grab resources from? The moon, Mars? Like, you know how much more difficult that is? So if we see a constrained energy system and the entire world is participating in it, not just America, everyone's going to run at stuff. So I think it's a bigger problem.
Be bigger than that. Well, I'll show you one thing. I'll come back to the. I have to show you that chart again. There's one line that right now something really, really different is happening, and after that, yeah, the uranium is right there. Let me get my chart.
Uranium one's awesome. I love that chart.
There's one thing that's happening here, guys. Is I could have drawn a line from 1980 using the 2010 or 8 pivot and stretch that line. So this is actually a double top. If that line falters, we're going your scenario. We're going, double this top. Is a 40-year trend line, rising trend line that gets broken down. Massive, massive top. It's crazy there. Because even in the 70s, this move down, the US equities hadn't reflated that much. They didn't tag the top line back in the 70s. They got to the median line, it slowed down, and that was it, right? Now this topping structure is massive, massive, massive. That's a 40-year topping structure. So this could just be the layup to the real move that's going to happen maybe in 2032 or later. I don't know, like, but this, it's a bigger pattern. There's a bigger pattern in play than what we think, you know. And guys, take a step back. What you have to notice, we're closer from a risk to reward perspective, because everybody wants to know where to invest, where to do. We're closer to a top in US equities, closer to a bottom in commodities than we are to a top. Once we get down here, of course, Andy, we should retalk. Okay, is this going to bounce back up? Should I take profits? Like, we're going to go through all that weight of evidence once we get to that line. But right now, it's the opposite. It's like we're not there. We're not blow off top in gold by any means. There's no blow off top anywhere. Not at least not on this type of landscape, right? Not on the 100-year chart. Like, where stuff is cheap. Real stuff is cheap now versus stuff that's like. Yeah, let's look at the uranium chart, man.
Yeah, I think you nailed it there. I think it's a double top on a huge, very long-term perspective. And what's even worse is they printed all this money and just jammed it into stocks, creating that gigantic problem of that imbalance. And now it's all unwinding on them, and they don't know how to stop it. They are so screwed.
Yeah, it's crazy. That's a huge. I have other charts where I have the U.S. purchasing power and everything's showing this is a 40-year pattern breaking down on multiple charts, like even the 10-year yields. It's a 40-year pattern from 1980 to 2020. These are 40-year patterns breaking down, man. It's like, I don't know, man. It's like keeping thinking that stocks will melt up forever is at this stage is pretty crazy stuff. Here is here I measured spot uranium divided by SPX. So this is pretty akin to the gold versus SPX chart, descending. I redrew this chart. I had a better line drawn. I'll show you later. The 2002, I could have overlaid this to the gold versus SPX chart. Commodities are commodities. Whatever fuels gold fuels everything else, right? Everything's financialized. There's not that many asset classes. There's US growth stocks and there's the rest. There's commodities, energy. You could bundle all that together. And look at this. One time, I think I measured the number of consecutive candles. It was insane, this one. I don't want people to go in FOMO. Like, I don't know if this is going to repeat again, but it went like uranium went up for like 56 consecutive months in the 2000s. It's crazy.
That's awesome.
We're right here, guys. So bottoming pattern. This is a clear trendline break. I did another version where I zoomed in. This is the daily chart. So this small explosion to the neckline, which is by accident or coincidentally the same place where we stalled 20 years ago. TA, guys, goes as far as you want. If it's in the chart, you got to consider it. So here was resistance. We hit that resistance, pulled back down to the early breakout line to retest. I did a zoom in. So the black is a monthly chart. This is a daily zoom in. And this tiny pattern, the pullback, is actually this going up, going down. It looks like it's an analog, right? it's like a smaller picture of this bigger move, right? Descending trend line. Nobody bounce off the 200-day moving average. I don't know where it is today, but I could have drawn this early breakout line better. This is a beautiful coil right under early breakout line. And look, the moving averages are going up. The benefit of the doubt, especially the weight of evidence, since we broke out from the early breakout line, you got to give the runner a chance that once it's gonna go and it's gonna do another go at that breakout line. And once, if ever you get a monthly close above this 0.01 line, you're here, guys. You buy the dips after that. Not yet. So people, yeah, uranium could crash, whatever. Chemical went down, I don't know how many percent. That's all fine, guys, because it doesn't have the sustained capital flows in its tailwinds right now. But take a step back, look at that chart and tell me, am I buying cheap versus US equities, or am I buying expensive versus US equities? And right now, you are buying in the cheap zone. You're in the base, right? This is the base versus US equities. You're not stretched. You didn't go parabolic. You're actually basing. Nobody loves the bases. Well, that's why bases are created. Like, oh man, it sucks. It's in the basement. I bought here in 2015 and I've lost all my money. Well, you shouldn't have bought in 2015. You should have sold when this parabolic run broke down. And then your job is to follow guys like Andy or myself, look at the charts a little bit. They'll give you the timing. And I'm telling you, the timing is closing in, guys. It's closing in, the timing. Combined to that, the PPI, SPX breaking down versus PPI, combined to that gold is closing in on breaking out versus SPX. That chart is getting close to breaking out versus SPX. It's like, I'll show you what chemical chart looks like.
I saw that chart, the uranium to SPX, and I was like, oh, this looks good. So I went and bought more uranium.
Well,
no joke.
People want to cost dollar average, or they want to buy now during the base. They don't care that this consolidates for 6 more months. Yeah, everybody could do what they want, but it's better to accumulate here than accumulate here. That's for sure, right? Even if this dumps and goes all the way down to retest that line even lower, you're still like at the bottom. If you're patient, eventually this thing's going to break out and you're going to have a huge move. Because look, here's Cameco, overlaid Cameco. Yep. And you couldn't like, Cameco tracks this. It tracks the capital flows. So people sometimes they tell me, yeah, but Patrick, uranium could go down, SPX could go down, and the ratio could go up, right? Because fine, yes, that's true. But when you overlay a third instrument, you don't care if uranium's going down or SPX is going down. You don't care what drives this, because the end result is the miner will track that ratio. So I could have probably put a correlation coefficient, and I would have proven to you that this ratio tracks positively the uranium price, right? Because a chemical is proving to you that. I just pop in the chemical chart on top of that. It's kind of funny here because chemical is like kind of a front leader. Chemical here had a hard pullback while uranium hadn't broken out versus SPX, and they decided to go sideways. And I know I don't know like where chemical is today, but when that line breaks to the upside, chemical was one hell of a horse to ride during all this, guys who don't want to buy futures and all the stuff like that. And you see they peak pretty much at the same time, topping structure, it fails, then you're out, guys, So yeah, that one is another big clue of where we are in the commodities versus growth stocks cycle.
The one thing I want to also like let everybody kind of know, just kind of let it sink in a little bit, is we have the SPX and producer price index breaking that trend line to the downside. And then we're seeing, I call it confluence amongst all of the other commodities in relationship to the SPX as well. They all are interconnected. They're all tied together. So if they're all tied together, then since you pulled this up, we should be seeing topping patterns in growth stocks and SPX and all these other things in dollar terms.
It becomes super easy. Like, I hope people start seeing the way we see things. That is essentially, we're showing you the Rosetta Stone to unlocking the financial markets. Because I started seeing this a while back. I did the gold to SPX, gold to SPX ratio. And then after that, Jordan, Roy Byrne, and I overlaid the silver chart to it. And he says, oh, look at Patrick. It's you just discovered like capital flows. He says that when money goes into gold instead of SPX, silver tracks that. And then that just like, it was a light bulb moment. And then whenever I look at charts, I know exactly in what category they are, exactly. Because I could have flipped this chart. So this, guys, is the Amazon divided by gold. And that's another thing, guys. We have to start pricing things in gold, because even if nominally they keep stuff afloat, your purchasing power, they're printing so many zeros that, look at that, in 2000 top, it lost 90% in like all the way here or here, 9 years. Like Amazon lost 90% of its value in the 2000.com top pricing gold, because gold had to rise to price in all that easing, all that stuff they have to do to save the markets. Gold has to gold price that in. So this is huge, 90% loss. It took 13 years after that. Here's the breakdown. I didn't measure the top. Oh, Patrick, you're measuring the top. Yeah, the top, it took more than 13 years. But I said at the breakdown level, once you break down from that topping structure, it took 13 years to break out. And that's measured in gold. And that's when you know you got to get rid of your gold here. And that was exactly when gold started breaking down. Even here, as this was showing relative strength, you sort of started thinking, oh, something's happening. You know, money's going back in growth stocks. I got to start bailing. So this is look where we are today. Beautiful, beautiful rising trend line. 3-year moving average, 1-year moving average, broke down, death cross, like name it. All these bearish stuff here, all the this is what I call the bad zone. So I'm below the sleep mode line. So you don't want to be long, whatever instrument that is. If you're below sleep mode line, you got to step back, take your profits, and wait. If you think this is eventually is going to be a bull flag, let's say this is a pull flag, well, why wait and hope it's a bull flag? Let's say you're not doing weight of evidence and you don't know about the SPX breaking down versus PPI, you don't know about all these other charts. Why waste your time praying and hoping that it breaks above this wake up line and you get another shot at making more money with your Amazon stock price and gold? You step back. Now we had a swing high here for Amazon versus gold. Below, it refused to go back above the 3-year and the 1-year. Right at the death cross, it turned back down. So now I'm starting to morph into existence a wake-up line. So for me, that's a trend line where if you close above that, something's changed. You got to, okay, Pat, maybe growth stocks will have another strong rally. But the bias has to be bearish when you're in the bad zone. And if ever Amazon gets below this final breakdown line, which I think it's akin to this topping structure here, 1 test, 2 test, momentum slowing down, right? Remember we talked about momentum slowing down from a rising trend line, cannot do a new high. That's awful. This is terrible stuff. You don't want to see that in an uptrend. You want always new highs. You cannot do a new high. Look, there's not much room left for Amazon right now. It's either it breaks down and it vomits in the bad zone, getting destroyed in measured in gold, or break to the upside and we have to revisit our weight of evidence. So it's not good, guys.
Here's a question. I get this question a lot. And when we go to that bad zone and Amazon pukes, vomits, rolls over and goes down, if it were to go in there, do you think that's going to drag down gold and other commodities with it? What's your opinion there?
I'm going to have to put pop up the chart of the actual NASDAQ price. If that thing goes down, gold is outperforming Amazon. Gold could be going down, but going down less. But that usually happens 1 to 3 months. Let's do it, guys. Let's do it interactively.
That's a huge question that a lot of us
I get it
ask.
But what I'm going to do the NASDAQ chart, NDX. Where okay, right here, this one here. I'll put it on here. I'll put my setup and I'll overlay the gold chart. I'll put the gold chart, put log scale. All right. When did gold bottom here? Gold bottom, I put a line here. Gold bottom. I'll put the lines where gold bottom in 2001. I'll put the line where gold bottom in 2008. Look where we are here. After this topping structure for NASDAQ, just NASDAQ on nominal price value. Okay, I have to zoom in a lot. Once it closed below the 3-year moving average, gold bottom, 1, 2, 3 months. So even when NASDAQ kept tumbling, gold, that was it. The bottom was in here, right here, back in 2001. Gold bottom about Depends which one you 1 or 3 months here below when NASDAQ closed below its 3-year moving average. Let's go to 2000. Here it closed below its 3-year moving average. 1 month after that was it. Gold decided to bottom and go up, and U.S. equities tumbled for another 1, 2, 3, 4 months. U.S. equities kept tumbling after. That's a lot of pain. It hurts to see gold bottom and go violently up while you're suffering for 4 months, right? And then that's when the gold to SPX ratio skyrockets, right? So where we are today. Look at that. This looks a lot like 2000. Oh yeah, I'll show you. I have another cool chart for that end either. So here it looks a lot like 2000, more like 2000 than 2001. I think we have maybe it's like the first chart. We're either 1929, 1970, or 2000. Seriously, like because we're beginning a cycle of inflation of SPX stocks breaking down versus inflation. So we're right here, one, or even let's say that depends where you start the counter. It could be 1 to 3 months before gold bottoms ahead of U.S. equities. If ever, as long as U.S. equities stay below this wake-up line here, as long as they stay below that, then this is a type of scenario we're dealing with here.
Yep.
So 1 to 3 months, that's pretty much what I'm expecting. So we're not that far off, guys. And usually gold will also bottom ahead of the Fed pivot. It will bottom before the US dollar rolls over. It's going to do all this stuff ahead of time before like gold knows. So then after that, we could just go back to the gold chart. Once it breaks out versus SPX, once it breaks out on its own chart merit. Look at this, man. Look at that. It's crazy. Like this is 2002 top, right? This is SPX versus Produced Price Index in 2002. This is SPX today. It's awful. It's below the cloud, below rising trend line, below 2 rising trend lines, below the 7-year moving average. That's like a 7-year moving average. It's like I'm giving this is not short-term volatility below a 7-year moving average. I'm giving the SPX a lot of chances to get back above a long-term, and it can't do it. And it's out of the cloud. That's just terrible. So it looks like it's a beautiful topping structure, repeats over and over, human psychology, whatever mechanics are behind that. Hedge fund managers are going to start looking at the math. They'll start seeing that the math doesn't work anymore for them. They'll have to allocate more towards. And that's funny because I just saw an ad. I forget which mutual fund it was. I was really surprised. Oh, we have this was on mainstream TV. We have new packages right now adapted to inflation. So these mutual funds now that before they were always pumping tech stocks. Now they're reformatting their packages to include inflation-sensitive instruments. I don't know what's in them, but you see already these big institutions now, they're going to start diverting money into inflation-protective, assets like probably, I don't know what's in those packages. And that's going to fuel, that's part of the dynamics of this happening right now. That's going to fuel commodities to rise. And they're probably going to keep directing money into those capital flows in commodities for a little bit longer than they should, right? Because they're always lagging those indicators. And that's going to probably create melt-ups towards the end in all the commodities. Here's the 70s. Somebody told me, Patrick, it's in 1962. Well, look, in 1962, the beautiful bounce the U.S. equities had versus PPI, above the cloud, above a 7-year moving average. There was no reason to think that even if it had a trendline break here, it didn't have the total weight of evidence of a breakdown. But look at here in the 70s. Total breakdown, 7-year moving average. Now we have a long-term trend line that morphed into existence. 1, 2, 3, break on the 4th. This also looks back to like the 1970s. So we have a mix. It's like history repeats, but not quite always the same. Well, that's what's happening. So these are analog moves, which are playing in different amplitudes and lengths. But the song remains the same. It's inflation, creating the havoc, creating the damage. The damage is done. There's enough inflation right now to create the damage to last for an 8-year, 10-year bear market in U.S. equities. Look, just here, like the 1970s broke down, and that's all she wrote. All you need is this. Even if they reflate U.S. equities nominally by printing whatever, the damage is done. Measured for inflation, because they're destroying your purchasing power, you're just not getting the return on your investments you should be looking elsewhere, like we've been you're doing on your channel, oil, energy, metals.
You know what's going to happen here? What I'm afraid is it's going to bounce higher like it did in the 1970s there, and it's going to be a massive bull trap. And it's gonna get everybody sucked in, thinking that it's going to go higher again, and then it's just going to absolutely rip it to the downside. Would you think that's possible?
Yes, definitely. Nominally, I cannot be surprised of anything. Even if nominally the charts aren't looking that good, they could still maybe in 1 year, 2 years have this type of crazy rally where, but us, we know. That's why I mentioned on Twitter, we're going to price stuff in gold. And if gold keeps outperforming US equities, even if nominally US equities go up, like let's say in a hyperinflation type of, because I think hyperinflation markets, right, or high inflation, US equities nominally, they look great. They keep going up and up.
Yep.
But we want to see the reality. We want to remove the illusion of fiat currency debasement. And we're going to use our ratio charts to really make sure that we're in the assets which are appreciating more versus the other ones. And that's what people should awaken to, is not, oh, my portfolio NASDAQ, it's flat, all that, or I'm a little bit above. Yeah, but your US dollar, the gas tank to fill it up, it's 50% higher. I'm sorry, but you're losing. You're losing the race of the debasement.
Yeah, I agree. I agree completely. Those are some insane charts, though, these long-term charts. I really love them because what it does is it allows me to see the big picture view, like I'm flying in an airplane and I'm like, wow, we're winning the war or we're losing the war, depending on what we're seeing. And I think from an inflation aspect, we're definitely seeing inflation, and it's having an impact on all the assets and how they're moving against each other and capital flows. Definitely.
Even the NASDAQ nominally, I'm not even adjusting it for inflation. Last month was a clear breakdown, like on the monthly chart. Pull, flag, now below the 1 year and 3 year. It's never done this in the past 10 years, closing below the 3 year moving average. Since 2008, it's never done that. This is important. So here's a scenario where if it could bounce there, it could start doing it now at any moment. So worst case, something like this there.
Yep.
I don't know where this. It could start bouncing now.
Yeah, it could do anything.
Yeah, it could bounce all the way here. It could trap everybody, go all the way up here to this wall. I don't like. Yep. But the weight of evidence is suggesting us that these are traps. All these things are going to be traps until it's able to overcome the PPI, until it's able to overcome, inflation assets. It's just not there. Man, even sugar's looking not bad. Wow. Yeah, look at that. Sugar's breaking out. Very close to.
Yep. Looks really good.
Whole flag.
Yep.
Oh, man. It's getting really close. So sugar's about. Here's your last chance. Here you had to pull back to the 3 year moving average above the cloud. So that thing, sugar's telling you, sugar has a great correlation of gold, of silver. So
not much overhead resistance either.
No, not much. Yeah, you're right. This thing could, it's a beautiful pattern. So that's another one, a leading indicator one. It's all these patterns, like all commodities got demolished since 2011, 2012, when US equities started outperforming once again the PPI. Well, now it's just, the script's flipped. Look, sugar is not, nobody's talking about sugar manipulation, guys. So if you want to look at maybe an asset that's like, this is.
I just gotta laugh. I gotta laugh. No one's looking at sugar manipulation. Like,
right?
It's funny because everyone's saying gold, silver, all these other ones. You just brought it up. I just thought it was funny.
It is. It's like, it's capital flows, guys. This is a beautiful bullish flag. Wow, this is insane, man. Yeah, look at that. That's a beautiful pennant. You can't ask better than that. If ever you get a monthly close above this, this is gold time, man. This is going to attempt to break out from this line here. And if it does, it's going all the way up here. So there's more clues.
You think Biden's going to release from the sugar reserve release?
Well, yeah, all that's nonsense. Like, honestly, this might not be a popular opinion, but I've come to realize that no matter how bullish or bearish the news, give me the most bullish news. Like, let's say there's no more bullion at the COMEX, they're out. You could take that same bullish news and put it at the 1980 top when silver was starting to break down versus, or SPX was starting to break out versus PPI once again. And the price action is still going to go where it's going to go. It's the capital flows. Everything's financialized. It's more about high level inflation, high level destruction of purchasing power. For me, that's what guides way more than any one event or any event that happens. Of course, like I could get more clickbait stuff by saying, oh, COMEX is ruptured, silver is going to go to the moon. Well, it's not enough, guys. It's not that's going to drive the price going higher. It's going to be those capital flows from those mutual funds deciding to go in one sector versus the other. Those are market movers. It's not something about no more silver in a warehouse. I don't think so. And I don't want people to get trapped because people have been calling I don't know why I'm talking about this, but people have been calling the death of COMEX forever, and it has nothing to do with, you want to make money, follow the charts, follow the capital flows. And after that, let's talk about narratives at the kitchen table, but place your money not according to what might happen at COMEX. Place your money according to what the charts are telling you. That's the only way you can make money. I cannot make money being wrong because I think there's a conspiracy somewhere. I can make money though by understanding capital flows are driving the price, which are driving the stories, just like those crazy Michael Saylor stories when Bitcoin was at 65,000 to the moon and mortgage your house. And you could clearly see that they were super stretched from their moving average. And Jesus, hell, if you follow narratives, I think I don't want to repeat myself, but narratives, guys, are built, when you think about it, narratives are derived from previous price action. They almost always are, because you need that feel-good story. You need the price to have moved and people start believing the story because of that price appreciation. And then they sell you that story. And then you buy into that story. But us, we know the charts that we're in uranium and we're in all these stocks that nobody wants. There's no stories attached to silver or gold. Or maybe there are stories, but they're not. It's the capital flows that are going to drive later on these stories. It's going to be crazy. I can't even imagine in 6-7 years, all the crazy stories we're going to start hearing, why gold's going up and all that. But I don't know, man. It doesn't matter what the story is, because they could have happened depending where you are in those capital flows.
What we're basically looking at is we're looking at people positioning in these assets. And it's the smart money taking positions in the assets that we can see through the charts. That's basically what we're trying to seek. Would you agree with that? Smart money selling, smart money buying. And we're charting out exactly what they're doing.
Yeah. What do you think moves the market? Is it mom and pop that you think it's retail buying whatever silver bars or retail buying Bitcoin that's moving the price? No, it's billions of dollars by hedge fund managers positioning themselves. They're moving the market. Maybe I don't know, man. Is it my naivety? But the markets are so big. I don't think it's me and you moving anything unless it's a penny stock. These macro tidal waves going in cryptos and growth stocks. It's index funds getting bought by these huge people recommending those stocks. People are like lamb. They'll just buy what people tell them to buy, with a nice story spin around it. So yeah, it says essentially that's what it is. It's all the narratives from all the analysts managing all those billions and trillions of dollars. That's what's happening, big money stuff. And only the racial charts over 100 years can tell you when they decide to start shifting the boat, guys. And they have, right? We saw SPX breaking down versus PPI. Even here, Bitcoin, clear breakdown, 3-year, 1-year moving average. It's about to do def cross. It's never done that before. It's like money has been flowing out of this thing, and people are deer in the headlights. Yeah, and even if there's a rally, nobody's going to sell. They're going to think it's going to go back up. But any rally in Bitcoin is an occasion to get out, and that's the big money. That's what they're probably going to do. There's probably the early big money they're creating this downtrend by selling everything all the time, unloading constantly. Yeah. And then there's maybe smaller big money, which they're just, okay, man, as soon as there's a rally, I'm going to sell into it, and then they let the reflate, and then they push down every time they can until that big money just pushes it down too much and they break down the floor, right? So that's probably the psychology of these big structures. And this structure in Bitcoin, guys, it's way more, I don't like it at all. It's not like this where it's like a blow off top and then went sideways for a long time. This is like a massive double top with a failed breakout. It's not pretty at all, guys. This is not good.
The double top there is just like what we're seeing on a humongous scale of the SPX to producer price index, in my opinion.
It's exactly that. It tracks that. Yeah, I don't want to hit Bitcoin, but I'm using it as a poster boy. Essentially, it tracks.
Yeah.
It's a leverage play on U.S. equities. Here is the, what did I pop here? What did I pop? Here's my SPX to Bitcoin. No, here. Yeah, SPX to PPI. So here's the
same thing. Yep.
It's the same thing. They track it's the capital. It's all capital flows. So right away, if you want to know, oh, Bitcoin's a commodity, it's gold. No, guys, you are what the capital flows define you to be. You could put labels on that, but I could probably call it the charts, chart A type, chart B type, chart C type. If you look like that, and on a 50-year scale time frame, you're doing that. Like for me, your chart type A or type B. Like there's not that many classes of asset. So Bitcoin is definitely part of the NASDAQ. It's part of the growth stock family, definitely, because it's behaving like that. So there's no way to cheat around that. That's what it's doing. That's how it's behaving. And until it closes above this line here, Bitcoin, there's nothing to look. This is a wake up line for Bitcoin. If it closes above this line, fine. Something's happening. It's waking up here. See, closed above. So this is it, guys. It's like
it's going into sleep mode.
Yeah. It's below the sleep mode line. It's in my bad zone.
Yeah.
You don't want to be long here because you don't know. Yes, it could go up, but you just don't know how long. You just don't know how long it's going to be here, guys. You just don't know. Why take a chance? Why take a chance? You want to be above a rising, inclining trend line. You want to be here, guys, above on these bounces. You want to be here. You don't want to be here. It just doesn't make sense.
Well, now here's a question. What about shorting Bitcoin? Is that something that you would want to do? Or is the inflation so powerful that it could overpower and push everything higher? And we should prefer to go long in, inflation hedges or something like that.
Yeah, well, I'm part of that camp. This inflation, I rather go long the metals than short, because I know nominally that stuff could get pumped up so much, and that I'll get triggered out of my nominal stop where I put it, and I'm trapped. Yep. So that I don't want to play that game. You could go, you could short Bitcoin, go long U.S. equities, but nominally this thing could they could reflate that for sure. So I rather track. This is the lesson, guys. You want to play stuff that's gonna represent purchasing power destruction. So I'd rather go long stuff that's gonna gold, silver, uranium, miners, whatever you want, call options, leverage your play, have fun with that. But I definitely rather go in stuff that have been basing for 8-10 years. That's something that's been basing or topping for a couple of years, where nominally you're right. It could definitely that thing could be jacked up, right? So I don't trust.
If they came out and they had to print for whatever reason, like let's say they just flood the markets because they have to save our bond market from a crash, similar to what the UK did and Euro and some of these other areas, we would see high inflation rates, which could distort all these charts upward as they just flood the markets with dollars, because the denominator there is the US dollar.
Yeah.
So
yeah, you gotta totally agree. Here's the PPI. Tracks it pretty much, but you're right. If ever there's a sequence where they devalue the US dollar, the anomaly, that stuff could go up there. Well, I had the example in the 2000s with the SPX. I'll put it here, SPX. Here's my SPX, remove drawings, and I'll just put SPX divided by PPIA, producer price index. See how, look, in 2007, back at all-time highs, but look what it did versus the PPI, way lower, right? So if you're shorting nominally US equities, you're getting trapped. You have to go long. Gold would have probably performed way better than the short of the US equities. Instead of making 100% on your short, or 80% or whatever the drawdown was from here to here, you could have went up, instead of going doing a one bagger like for 50%. Your miners went up. I don't know how much more times. Here's the 70s. Here is the inflation adjusted lower highs, but look what it did here.
Mm-hmm.
higher highs right before it crashed in 73, right? So yeah, I think we kind of the charts kind of answered it. Shorting nominally, unless for a nimble trader, they want the adrenaline. I shorted 2008. I loved it. It was like the best feeling in the world. Seeing 800 day when you took a short, like before everything tumbled, it's a great feeling. But if you remove the emotions, you're better just going long. The precious metals complex, the commodity complex, etc., and just have your shares of those companies, just hold them tight, and you won't have to worry about a margin call because nominally they printed money away. That's crazy. Look at this divergence, man. That's insane.
I know, it is crazy. It's like hidden. They're just hiding all the reality from everyone.
Yes. Well, but you know what we talk about is gold shows the truth, right? Silver shows the truth.
Yep.
You know, like silver, all that stuff, copper, like all these inflation hedges, they're actually, a better word would be they're purchasing power hedges more than inflation hedges, right? Because the US dollar is the other component of purchasing power. The inflation adjusted US dollar is your purchasing power. Oh man. What else do you want to talk about?
Well,
fun.
So the first thing is all getting the macro right, which we just did. But how are you playing this? How are you partaking in playing this? Are you more precious metals heavy, energy heavy, uranium, commodities? Like what do you prefer? Like what's your favorite sectors?
Well, I think if we had a 2000 type of run, and it's unfortunate I don't have uranium prices for previous, like uranium and oil are going to run hard in the early stages. So I've seen in 2000, uranium and oil, they peaked in 2007. Even if they had a rally after the recession really hurt them, the GFC, they never really, unless you bought at the bottom of the GFC and you ran up, they didn't keep going up as fast as gold, because gold didn't go down as low. Even silver didn't go down as low as uranium and oil. But those would probably be, I'd have a basket essentially, like we have them on our website there. Uranium stocks, silver, gold stocks, energy stocks, shipping stocks, that tracker, oil tankers, natural gas, all that stuff. All those horses. It's fun having a little bit in each of those, because sometimes one's going to go faster than the other. But I could have overlaid any one of those miners in any one of those asset classes on top of the gold to SPX chart, and they track it pretty much, right? So if you want some variety and you want dividend paying companies, you want you don't want to be stuck just to silver, because let's say silver's going down, the miners going down. You see all your friends in uranium making a bunch of money, and then you just feel bad, and then you might sell wrongly because but if you have it, you're spread out. Every time they go up and down, they're not going to all move together. Then at least psychologically, it helps a lot having spreading. But you definitely not growth stocks. It's like choose anything other than growth stocks, please.
Yeah, you could throw like a dartboard up there. You could put like gold, energy. You have some other commodities. You just start throwing it, and you're like hitting these, and you're like, I'll go into that. I'll go into that. I'll go into that. And then you got like growth on a totally different one over there. You're like, don't go over there. We're not playing that game.
Don't play. Yeah. And guys, like a lot of our members, they do the fundamentals analysis. They love the companies. They love the dividends. Like, great. But at least our role is just identify the correct asset class. And the asset class is not US growth stocks anymore. It's just not. It's basic materials. It's commodities. That's the asset class, which is going to showcase the purchasing power destruction that they're going to do. They've always been doing it, but the pace will accelerate right now, because purchasing power starts from top left on the chart for 100 years, practically to bottom right. Like, they've been destroying forever, but they have cycles where it really, like, the rate of change of destruction of purchasing power augments, and we're in one right now. And that's another chart. The rate of change for the 4-year, 8-year of purchasing power is breaking down from another 40-year rising trend line where they're accelerating the destruction of purchasing power. It's gonna be crazy, awesome. Andy, man. It's like, awesome. I hope people see this video so much. I'm gonna retweet the hell out of it to make sure and do clips. I'm trying to do that now. I'm doing clips because of TikTok, they can't even listen to a 7-minute video. So I'm starting to do small clips and putting them on Twitter so people could get these important messages like consumable, in 60 seconds. We're just trying to help people, right?
Yeah, definitely. So, do you have anything else to add? Any closing comments or conclusions or anything?
Don't get trapped, guys, by the daily noise. Follow Andy's channel. Follow me on Twitter, or Kevin Wadsworth, North Star Charts. And if the big picture changes and the thesis changes, we'll post it, guys. There's no issue there. But right now, the weight of evidence is it's what we've been describing there. We're very close to a long and meaningful bull market for commodities.
That's awesome. So thank you, Patrick, for coming on. I really appreciate it. Yeah, I think I love the charts from the big picture view. That's kind of how I see the world. I see the big picture charts, and yeah, that's all I've got. So thanks for coming on.
Cool stuff, Andy. Take care, guys.
All right. Yeah.